In this video, I'm going to teach you everything you need to know about calendar spreads. So let's start by looking at a stock. We're going to look at QCOM. QCOM has been heading downwards, but if you'll notice, it has a lot of these big gaps. Now the big gaps, what's interesting about them and why I generally like to open credit spreads after gaps is that if we think that the stock is going to trend sideways and there's a gap before we open the calendar spread, what we're doing is we're betting that volatility is going to rise. Typically after a gap, volatility does go up. So that's what we want, and I'll explain why we want rising volatility later. Now when you open a calendar spread, you generally want the strike prices to be at the money. So whatever closest to the current price of the stock is the strike price you want. So you're going to go to your brokerage firm, you're going to open the options trade menu and click on spreads. Once done, you're going to enter your ticker and you're going to buy and sell. You're going to buy to open and sell to open. Now you're going to buy and sell the exact same thing. You can use calls or puts, it doesn't matter, but you got to go with both the same. So I'm going to choose puts. And generally, if you have a thesis that the stock is going to trend sideways, you should have a backup thesis. Is it going to fall or is it going to rise? In QCOM's case, I think it's more likely that the stock will continue to fall than it is to rise. So I'm going to go with puts. Now, if you think it's going to rise, you go with calls. Okay. Expiration date, when you buy and sell open, you want the bought expiration date to be closer. So I'm going to choose February, and I'm going to choose the sold one to be March. That's the only difference between these two options. The strike price is going to be the same, and the closest strike price right now is 44.5. So once you got that in, it's going to tell you the midpoint. It's going to cost about 115 bucks to open this position. That's what you put your order in for. Now, once you order that, what is going to happen? What do you do once you have that in your portfolio? Well, if you spend 115 bucks, what do you want to happen? You want a couple things to happen. First of all, you want the stock to trend sideways. If it goes too far up or too far down, you're going to lose money. Now, you can save yourself by closing the position early and taking a loss. Another option is if it goes down and you've got puts and you believe that the stock is going to continue on downward, you can buy back. Sorry, I screwed this up. You want to buy the further out of the two. And for some reason, okay. All right, I screwed that up. So let's take a step back real quickly. You're going to buy the further one out. The strike prices are the same. You're going to sell the closer one. All right. So what happens if this goes downward? Well, you can buy back the closer one. You can buy back the February option. And now what you have is you have a March put option. So if QCOM continues downward, your put option is going to go up in price and you will make money that way. All right. Now, if it goes up, if the stock goes up, you're just going to want to close the position. And to close the position, even when you're done, when it's close to February, and I'll explain that in a second, to close the position, all you have to do is the opposite. Instead of buy open, you sell close. Instead of sell open, you buy close. You just do the opposites, all right? Okay, so that's how you close the position. Now, when do you want to close the position? Well, like I said, you're hoping that QCOM trends sideways until this closer of the two expiration dates. And you're hoping that volatility rises. If volatility rises, what you get is what's called a volatility rush. And what that does is it makes the bought expiration of March, this bought option, it makes this option go up in price faster than it makes this option go up in price. All right? So by doing that, you have an option that's up in price and another option that's up in price, but this one the one you're holding on to went up in price more quickly than the one you sold, which means you made more money than you owe. All right, so that is the profit. You're making a profit margin between these two. Now, when do you close this? When do you make profit on this exactly? By the way, the midpoint here is 0.0989. When do you make profit on this? When you close the position? Well, you see how the expiration date is February 19th? What you're going to do is you're going to close hopefully on the 19th, but you can close anytime during that week of the 19th. And you're going to just close that entire position. You're going to sell to close, you're going to buy to close, and you're going to close that on February 19th. Now, you got two situations. One is QCOM is trading at your strike price at 45. Well, technically above 45. If it's above 45, this is exactly what you would want to do, but you don't have to. Another option is you just wait and you do nothing, and this option here will expire. So February 19th, if the stock price is above 45, this will automatically expire, and you'll just take the money that you got from selling that. So you'd take the 167 bucks. Right? And if that happens, you're holding on to a put option. Now, the only situation that you would want to do that in, where you just don't do anything, is if you're pretty sure that QCommas could continue downward. If that's the case, this option will go up in price. But now you've switched your strategy to a pure put option. Generally, what you want to do is simply wait until February 19th and then do this exact thing you're looking at right now. Sell to close, buy to close, and you'll come out with a profit. So you might have opened this at 0.89. Generally, you'll come out with a profit. Sometimes the profit will be quite large, like double what you put in. So because calendar spreads typically are cheap, I generally buy multiple of them. I'll buy like 4 of each. So I'm spending about 400 bucks. And then if I do make double, I made 400 bucks instead of just measly $89. That's how it works. Again, find a stock that's trending sideways that you believe volatility will increase on. I like to choose gap stocks. If it trends sideways, you're good. And all you have to do is buy to open and sell to open the exact same option, except with the bought option having a later expiration date. And it doesn't have to be the next month. It can be actually 2 months out there if you wanted it to. Of course, that's going to make it a bit more expensive, but it's the same overall strategy. That's it. When you're ready to close, you just do the opposite. Instead of buy open, sell close. Instead of sell open, buy close. And you do that on February the 19th. So the closest expiration date, you do that on that day. That's it.